In today's video, I want to bring back one type of video I used to make a while ago, which are the quick examples of more advanced price analysis. Over the last year, I was more focused on free video courses of common techniques, where I show advantages and disadvantages, but these videos take a lot longer to create. A lot of people are sending me emails because they missed the old videos where I analyze some market scenario, so that's what I'm going to do today, and I will try to do at least one of these per week. Regarding the new paid course, I'm extremely excited about how the course creation is evolving. Just so you can have an idea, just the risk management section of this new course is probably going to be larger than the price section trading volumes 1, 2, and 3 combined. The other sections about trading techniques, examples, science behind price movement, behavioral economics, and neuroeconomics are also going to be very comprehensive. It's going to be a tremendous evolution in comparison to the current courses. A lot more content and much deeper content as well. Given the amount and complexity of information, I imagine that this new course is going to cost around $400 to $500 and is probably going to be released by the end of the year. So if you have interest in what I do, it's a good idea to start saving some money right now. I'm sure this will take the fractal analysis of markets to a whole new place. My goal is to create the most comprehensive and scientific trading course ever. I'm also going to introduce new tools. There is one tool in particular that I believe to be as powerful as the pitchfork, if not more. Anyway, this new course is going to be great and I cannot wait to release it. I will tell you more details throughout the course of this year. Going back to today's video, I want to start analyzing the 1-hour chart of the E-mini S&P. Generally speaking, I like to look at currencies. That's just a preference I have. The trading techniques I use and teach can be used in any market in any time frame. By the way, that's a question I get all the time. People ask me what techniques they can use in certain time frames, and the answer is that all good techniques are universal, meaning that it can be used in any market in any time frame. Price charts are fractals generated by human behavior interacting in the rules of supply and demand. That's the case with any market you can imagine. Any technique that captures this behavior in one way or another can be used in any price chart you wish. There is no such thing as a technique that only works on a specific time frame, unless we are talking about bad techniques, but that's a different story. Notice that in this chart, the E-mini S&P forms one vector up and then a vector down, closing slightly below the beginning of the upward vector. This makes the high in between the two vectors a solid high. What this means in practice is that this high represents a place where sellers proved themselves in a way because they were able to come out of there and create a new low, however shy, which is a crude sign of strength. For people used to the methodology of price action volume 1, you can begin looking at the supply zone upper and lower limits in that high. Remember that supply is about sellers and demand is about buyers. The usual suspects are the inward and outward frequencies. It's always a good idea to keep an eye on the absolute high as well. What we want to do now is to observe how price behaves once it reaches that region, if it does reach it at all. Notice that right after sellers made a new low, a fractal bar is created, which is not a reversal signal, but it's an indication of demand power in this context. Remember that fractal bars by themselves will tell you nothing special. They need to be considered in the context in which they appear, just like any other technique. So let's fast forward price a few bars to see how it develops. Price starts to rise immediately after the fractal bar that was pointed out, but the important thing I want you to notice here is the behavior of price once it reaches the supply zone drawn earlier. The key word here is indifference. Price doesn't seem to care about the inward and outward frequencies, and the absolute high as well. Price action is developing as if those levels are not there. This can be an indication that price will continue going up because those sellers are not being capable of creating any sort of significant bump in price at the moment. Beyond that, look how smoothly price has been rising up to this point. It looks like there are no barriers for buyers at the moment. When we look at this, it seems like there are all the reasons in the world to buy and to avoid a short trade at all costs, but it's too early for that. We have some sort of bias here, But we need more than that. We need location and timing. You cannot just open a trade in the middle of nowhere, because that will cause bad risk-reward ratios, which by itself will cause more downside volatility in your equity curve, which is something that you certainly want to avoid. Upside volatility is never a problem, of course, but downside volatility is a problem. So given our current bias of weak sellers and buyers free to go, we need to start looking for places where buyers could pick the market up, and here we need to start looking at the recent past. If we look at the last vector down, we can see that we have three main vectors embedded in it. When buyers picked the market up after the new low, they broke down the supply zone in there. Notice how there's a little turbulence in that area. If we catch the outer frequency in that smaller supply zone, we'll see how things start to line up. Buyers broke it to the upside and then tested it on the other side as support. This can be seen as an early indication of the failure of the larger supply zone we are talking about so far. Notice how there are many subtle details between the bars. There's a whole narrative being built here, and that's precisely what makes high-quality trading difficult, reading what's between the bars in real time. There's no technical indicator that is going to tell you that. You need to use your brain if you want to reach this other level of analysis. That's difficult to do, of course, and that's precisely what makes it good, because the place where less people want to go is the place where great opportunities dwell. Given this more refined context, let's advance price to see what happens. This is the bar that ties the context together in a way. If you are a careful market reader or analyst or whatever you want to call it, this is a bar that will catch your attention without a shadow of doubt. First of all, the bar itself is telling a story. It's a high volatility bar with a large lower shadow. This basically means that sellers started to get some power, but once they reached a certain level, more powerful buyers appeared to scare those sellers back up. This is the kind of simple logic that makes that bar close with that prominent lower shadow. The lower shadow begins in the horizontal line that shows the moment where buyers switched the quality of the line that represented the outward frequency in the middle of the large vector down. It's also a small demand zone created by buyers. Notice that we have a continuation divergence here as well. That's the only reason why I plotted this RSI, by the way. We know that this is where strong buyers are at the moment, so now we have a bullish bias, a location, but we need timing as well. Now there is a difficult choice to be made. We could enter a long trade at the open of the next bar, but the large lower shadow represents a large stop, which is never attractive. However, if you want to speculate that price will travel a lot to the upside, a larger stop is not a problem. I'm not going to go into detail about secondary entry types because that would make this video too long, but the idea is to try to maximize risk reward by getting a better entry. The problem with that is that you can end up missing the trade entirely. There is no way to know when price is going to give you other chances to getting the trade or not. This is something you have to decide arbitrarily. In any case, the logical stop loss placement happens in a level where we have some protection from strong buyers, which is below the small demand zone we can see here. Let's fast forward price to see what happens. As you can see here, price doesn't give other chances to getting that trade. It just takes off from there. There are multiple ways to getting that uptrend along the way, but this would be a subject for another video. Notice, however, that if you enter the trade at the open of the next bar, even with a large stop, price travel enough to yield a 1-to-3 or 1-to-4 risk-reward ratio easily. Actually, you could get a lot more than that, but we know it doesn't make sense to aim for risk-reward ratios that are too high all the time. Statistically speaking, you should aim between 1-to-3 and 1-to-4 most of the time. Yes, you could make more than that, but that's a counterproductive thought in the end. The bitter truth about this is that sometimes you will produce a very good analysis and you will miss the entry. That will jeopardize everything. That's just the reality of high quality trading. It's one of the costs of trading with higher precision, but remember that trading with higher precision is a necessity, not a caprice. Optimizing risk-reward ratios is a delicate game, and that is what makes the difference in the end. So that's it for this video. If you want to learn more about high-quality trading techniques, check out my courses on the video description, or send me an email so we can discuss the best course option for your level of experience. If you have interest in more than one course, we can also talk about bundle deals. If you like the material I produce and you wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.